Welcome to Buffetting, the podcast where my wife Kass
Ew.
and I share our conversations on investing with you as we try to keep compounding capital so I don't have to go back to being a carpenter.
And I don't have to go back working with real estate agents. We hope you find it informative and entertaining.
But we are not your financial advisors and nothing we say should be taken as investment advice. As always, do your own research, which is more fun.
And now, without further ado, on to the episode. So I guess this will be our third episode on inflation.
Mm-hmm. Are you sick of it yet?
I'm so sick of it. But it's so important.
I know. That's the thing. It's like you don't get to choose the opportunities that you don't get sick of. Like, you know, obviously looking at some interesting company is always good. But, yeah.
I think with this as well, we feel like it's just as dangerous as the virus was.
Yes.
You know, so we're getting that same kind of feeling.
Yeah.
That it's really important people know what's going on.
Yeah.
And it's really important that people talk about what's true. So inflation is real. It's not transitory. This was quite obvious quite a while ago.
Did you see what Yellen said about that transitory word? She's like, many people misunderstood what I meant by transitory. That's what she said.
Let's change the meaning of the word instead of saying we were wrong.
I feel like I'm being gaslighted by Janet Yellen. Janet, I thought you meant this. You know?
Janet, don't play semantics with me.
Janet, don't do that to me, please. I trusted you. I trust you, Janet. It's all right, we trust Jay now. But yeah, when we started reading about this stuff, me and you, when we were thinking about it, we felt like we were the only ones who were really serious about that this was going to be like a serious problem, basically. And there was going to be a hard problem to solve. And since we first started, there's been a lot of change, isn't there?
Which is why we're doing a third episode on inflation, because it is really important. And we got an active hedge on, which we think is a really good opportunity for people still. I mean...
Yeah. I mean, the hedge it's moved like a fair bit in our direction, but the pricing is still very cheap for someone if they're interested. Like, you're looking at somewhere between a 10, 15, 20x return if, you know, rates move 1 to 1.5% at the long bond market. So that's pretty crazy opportunity, especially if you've got a fully invested portfolio of like highly valued stocks, you know. But the good thing is about the hedge, and what we kind of said at the start, was that it's a monitoring process. So every month, every week, every day, we do have some things that we're tracking, like in terms of CPI and what's changing, but we've gotten, just by reading and just by looking in the frequency of articles and the intensity of those articles and, you know, what kind of future those articles are talking about, you know, and how negative or positive, you know, inflation is projected to be. You know, there's articles in all the major papers every day now talking about quantitative tightening, talking about, is inflation transitory? Is it going to be solved? Like, it's pretty intense how discussed it is now as a topic, and that's what we were looking for, wasn't it? Like, we were looking for that to happen over time. Right.
And those same people saying only 2-3 months ago, inflation's transitory and it's going to go away. The Fed shouldn't touch rates because they're going to hurt the market.
Exactly.
So the same people have changed their narrative. The Fed themselves has changed their narrative.
Yeah.
But the bond market has not changed much.
Exactly. And there's a lot of focus on like what effect will quantitative tightening have, which is basically just the mechanism of the Fed unwinding buying bonds. It's just they used to be buying a lot of bonds and they plan to not buy a lot of bonds in the future. But ultimately, the goal of everything, and the only way they're going to have an effect on inflation, is if it becomes more expensive to borrow. Like, it's not actually very complicated. Like, there's a lot of discussion around like, what effect will this have? And what if they stop buying in this date? And what if they roll off on this date? And like, it's really confusing. And I think people are just missing the wood for the trees. Like, it's just, what is the problem? The problem is that inflation is out of control. Like 7.5%, very broad based across all factors. I think I read like 87% of small businesses have rose prices of their products in the past few months. Like, people are raising prices across the economy, across all services, you know. So to stop that, you need to tighten across all services. And that's where the only thing, well, the whole bond market is still at pretty low interest rates. And they keep, the bond rates keep adjusting every time the Fed says something. But it's not taking into account, if you look forward a few months and said like, okay, well, taking into account that they don't really tell you what they're going to do in 6 months' time, they kind of adjust things slightly, then you would pretty much see that just because they've said one thing doesn't mean that's what they're going to do. And that, you know, over time, they're going to keep breaking this bad news to you slowly, that rates are going to have to go up and go up quite substantially. And the biggest thing that we think is going to happen next is that the long-term bond rates are going to rise. Long-term bond rates are like always what gets hurt the most by inflation. But ultimately, not only is that a consequence of inflation, but also raising the rates of those long-term bond rates is going to actually create a tightening effect. And they actually have to do that. They have to tighten those long-term bond rates because that's what affects mortgages. And mortgages is what affects CPI, exactly. You know, over time. So it's all basically connected, but focusing on this factor or that factor is not so important. It's more focusing on what do they have to do to solve this problem, which is now being accepted as a real problem. The good thing is that what we thought was going to happen 6 weeks ago, or what we thought was likely to start to change, in the sense that it was kind of similar to the virus, in that this is a big, scary, terrible problem for investors that people are probably going to be slow to recognize. People are probably going to be slow to accept that you've got to put your required returns on your valuations up like 2%, 2 or 3%. Not a very nice thing to have to do. You know, not a very nice thing to have to tell your investors if you're a professional investor, that's for sure. If you're a bond investor, that's like what you're specifically doing. What do
bond? Yeah.
Yeah, I mean,
they've just been going to work and just sitting there. And
it's like they could buy tips. Like, can you put your whole portfolio in like, you know, inflation protected?
What they should be doing is updating their resumes.
They should be making them seem like they're like mining focused. It's like, yeah, I was a bond investor, but you know, I'm actually going to be doing mining from now on. You know, but yeah, we kind of thought that it was underappreciated, basically, how big of a risk it was. And it seems like a lot of people are starting to appreciate it, I think. And considering how much the Federal Reserve has changed over the last 6 weeks from saying 2 or 3 rate hikes, now it's more like 4 or 5, feels like consensus. And you've got one guy coming out today, Bullard, who said, I want to be at 1% by the middle of the year, which is a big change, you know. So that's kind of where we're at.
And that's a massive change in narrative, just in a short amount of time.
Huge, yeah.
Because like on our whiteboard, we've got listed all the Fed narrative over the months, and like only back in, I think, October, they were saying, well, tapering was finishing in June, and there wasn't even a mention of rate rises.
No. Yeah.
So now we're at the start of February. Tapering is ending in March.
Yeah.
And people are throwing around a 50 basis point possible rise in March.
Exactly. Definitely the world's changed a lot. And like, yes, our hedge is in profit, and that's good. It's moving in that direction, which is cool.
We just think there's still a long way to go.
A long way to go in terms of the market accepting what's likely to happen.
So yeah, I guess let's have a bit of a recap of what inflation is doing now.
When you look at the CPI, 60% of it is shelter and food. The rest of it's kind of energy, education, healthcare. So anything where there's like a service attached to it. So it's like, you know, healthcare, education, like you need a person for that. And wage inflation is gathering steam, gathering pace. And that is the fundamental driver behind those numbers and what's going to happen in the future. So if you think that those things are going to be like negative impacts on inflation or whatever, then you need to believe that wages are going to start going down, which is not likely.
Not likely.
Not likely.
And once you account for the fact that the whole housing boom over the past 18 months is only starting to get reflected in the shelter CPI now, and shelter is 42% of CPI, it's going to be a pretty bad year ahead for inflation. So
definitely,
that's what we're basing our understanding on, that inflation is bad and it's something that is going to require higher interest rates to tackle.
To deal with, exactly right. And it's true that a lot of the things that are causing the higher prices are not in the government's control, like commodity prices, for example, like fertilizer prices, oil prices, prices of metals, like all of that is contributing to higher goods prices and higher car prices and higher washing machine prices and all that kind of stuff. And yes, there are fundamental factors as to why the housing market is experiencing rent inflation. It makes a lot of sense that there hasn't been enough building over time, and there's been a massive amount of people who are now working from home. They want a better house, they want to move somewhere else. Interest rates have been very low, so it's quite cheap, or has been quite cheap over the last year to get a big loan, move to a different area. That creates friction, that initiates, furniture buying, goods buying, Peloton buying, screen buying, computer buying. All those things are part of it. But the fundamental drivers behind it all, they just don't seem to be abating. They don't seem to be stopping.
No, which is purely demand, consumer demand.
Yeah.
People's appetite for spending, for wanting things.
Yeah. If people couldn't afford to do any of these things, then the prices wouldn't be going up.
Yeah, and that's where we run into the big issue of the money supply argument, because the increase in money supply is not an immediate problem until that money is being used in the economy.
Yes.
And so if half of that money printing is just sitting in bank reserves, so it's basically the banks have massive capacity to still lend to people whenever people want to at low rates. That's the money supply danger. Yeah.
I think we think about it like you've got people's, cash balances and their assets and stuff and the money and their income and that kind of thing. And people's incomes are going up, which is going to allow them to spend more anyway. But there's also these two huge reservoirs of inflation, and it's capacity to borrow, which is bank reserves have created a huge amount of capacity to borrow, also to lend out, from the banks, but also the markets. The markets have been in a huge bubble. Any measure you want to pick, big bubble. Okay. So that whole thing is just one transaction away from spending power in the real economy.
Exactly. They're all just dams of money.
Yep, exactly. So the lower income, from what we can tell, hasn't accumulated a huge amount of savings. They've paid down debt mostly, it seems like. But the top 60% of Americans have got huge excess savings. And one thing we know about Americans, and I would say Australians too, we have a very consumer kind of culture. It's like if you have the capacity to spend, then you will spend. The problem is at the moment you can't get anything to spend on. So there's still this built up desire to spend, we think, is there. Which is where
one of the arguments against inflation becoming worse is that people look to that credit impulse score, and because that it's not appearing like people are taking on more credit,
or they weren't in the period that would forecast the coming period. It didn't look like there was a lot of people taking out credit, and credit has predicted inflation, which makes sense.
If there's things that you can buy with credit.
Yeah. Is there a car available to buy?
You can't buy a car. Well, you can buy a car, but you have to wait a year. Houses, the housing supply is limited, which is why the prices are going up.
I read somewhere that there's apparently more real estate agents in America than listings.
Brilliant.
So how are you going to,
real estate agents? Work on your resume as well, I would say. Bond managers and real estate agents. And possibly the Fed.
Yeah.
Yeah. So that's why we're so concerned, I guess. We've got a million more points. I guess this is the problem, that it's taken us so long to feel comfortable doing another update on inflation, because every day we listen to Joseph Wang, Larry Summers, Grant Williams,
Jim Bianco,
all these amazing people who really have good technical knowledge.
Yeah.
And every day we're learning more and more and more. And so it's like, at what point do we know enough today?
We've got to unload some of that brain knowledge, and I guess put it out there to be criticized, to be actually have people hear it and say I disagree with you, I agree with you, whatever. But the question that's going to be really relevant to everyone's investment portfolios in the coming few months is, what is the Fed going to do exactly? Like, we know what the problem is. The problem is we now have broad-based inflation across every item, pretty much. And how's the Fed going to solve that? Well, higher interest rates. But there seems to be this gap in everyone's knowledge where they think that they're going to, jack up short-term rates, so like 2-year, 1-year rates. Those things kind of relate to like car loans and personal loans, that those rates kind of correlate with that, but they're just not going to bother to touch 10-year, 20-year, 30-year rates because for some reason they just won't worry about it. Like, no, those rates correlate to the cost of buying a house. Those rates correlate to rent 18 months later. So it's actually, from what I can tell, it's vitally important that they do everything they can to make it more expensive to buy a house, to discourage people from continuing to bid up the restricted supply. Yeah.
So that, I guess that takes us to our hedge. Our hedge, basically, the underlying thesis is that long-term bond yields have to go higher in line with short-term interest rate increases.
Yes.
And we think it's also in the Fed's incentive for long-term yields to go higher as well.
Yes.
But the market in rabbit ears, what do we call those things?
In air quotes.
The market is not pricing in
No.
future yield increases. But Stanley Druckenmiller himself has said the bond market is not giving you any signals right now because the Fed is the buyer in the market. They're distorting all the signals. You can't even read from it at the moment until March, until the Fed pulls out.
Exactly. And with our kind of 3 points of evidence on why we think that the long-term rates are going to go higher, I feel are pretty solid. We've got Druckenmiller, one of the greatest investors of all time, understands the bond market. He's made a lot of money off the bond market. He actually understands that. He said that, a lot of money he's made at these big turning points of, the economy, basically.
He's made money in every market, let's just face it.
The guy's a genius. If it was just him saying it, I'd probably believe it. But, we don't really think that way. We try and be critical of everyone's opinion.
But he has been accurate on his views on inflation for a long time as well.
Definitely he has. Bridgewater CIO, Greg Jensen, came out and said that he feels that the market pricing of the 10-year bond rate is somewhere between 1.5% and 2% higher than where it is now. So that would be a bond rate of not 2%, but 3.5% to 4%, which would increase house
interest rates
for housing, by about 1.5%. That would be a lot.
What the Fed really wants to happen.
Yeah, exactly. And then you've got, of course, one of the Fed voting members of the FOMC. I can't remember what her name was, but she came out and she said that it's bad that they're holding down long-term rates because it's encouraging risk-taking, which is not what they want to do, and that she feels that once they stop, being a buyer in the market, if they get out of the market, rates will also go 1 to 1.5% higher. So you keep getting this echo from all these people who understand the markets a lot better than I do and you do, saying that this is what we want, it's going to happen, it's what needs to happen. And instead you've got people who keep focusing on the fact that yield curve inversion, which is the... Let's see if I can get this right, okay? Because it's hard to explain it in words, but I'm going to give it a shot. Okay, yield curve inversion is when the 10-year rate is the same rate as the 2-year rate, okay? So what does that mean? When
you looked into it, you're like, well, it's really important to know, is it the short term going up or is it the long term going down in an inversion? Exactly. What has actually happened in history?
Is it people piling in to lock their money away for 30 years that's caused long-term rates to go down and that's caused the yield to invert? Or has it been people pulling their money out of short-term rates, which has allowed short-term rates to go up to meet the long-term rates? Hopefully that makes sense.
Yeah, so if you go back you've looked at every single time a yield curve inversion has taken place.
Since 78, so since the end of the inflationary period, in the 70s, I looked at every point where the yield inversions actually happened. The first time it happened was in 78. okay, happened at 8.46%. 2 years prior to that, the 10-year rate was 7.6% and the 2-year rate was 6.5%. So basically, interest rates went up, but short-term rates went up more, okay? And they met at 8.46%. Now, there was no QE that I'm aware of in 1978, okay? There was no Fed market participation in that market, okay? So that was pure market signals. That was the market saying, okay, I can buy bonds, I can buy stocks, I can buy commodities. I'm moving my money in such a way, the pools of money, that, you know, those two interest rates become the same. But so the next time it happened was in December 88. Again, the point or the interest rate where the 10-year and the 2-year were the same, 9.14%. You know, it doesn't really feel very similar to our period history, you know, that we're in now. The next time it happened was in January 2000. The two interest rates were the same. They met at 6.61%. So again, it's the same kind of thing where interest rates are high at these points where the yield curve inverts. You know, that's what made it kind of feel a little bit unusual to me. And then the next time it happened was in January in 06. So the most recent times, 2000 and January 06, massive bubbles.
And that was at 4.54, the inversion occurred.
Yeah.
So all really high interest rate periods.
Yep.
Generally during asset bubbles.
Yeah.
And also you found that it was actually people pulling out of the short term, 1 and 2 year, and putting their money into the bubbles.
Exactly right.
Or elsewhere.
Exactly.
So it's very different from today, where people are saying people are going to pile into third or long term.
Yes.
And those yields are going to be pushed to negatives.
Yeah, it's very confusing. It's very confusing to me why people would think that this idea that the 10-year rate is going to be like 2% or 2.2%, and the 2-year rate is going to go up to that point, and that's just going to be how the market's going to see it. It doesn't make sense to me. And the biggest thing that makes all of that completely irrelevant to now is what Druckenmiller said, to make it full circle, and what everyone else in the market is saying. Everyone who understands the bond market really well, much better than I do, says that when the Fed is out of the market, the rates are going to be going much higher, which makes the yield curve inversion not likely at all. You know, if the long-term rate goes higher and the short-term rate kind of stays where it is or goes a little bit higher, then that's a pretty normal-looking yield curve. You know, like 1% for 2 years and 3% for 10 years and, you know, maybe 4% or 4.5% for 30 years. That's kind of a normal duration term premium kind of situation. So basically, So the argument that there's going to be buyers for long-term bonds in the future is because there's this threat of recession and people are going to be forced to, people just want safe, secure returns of like, what is the return at the moment? It's 2% or something for a 30-year? Yeah, it's 2.3%.
So people are going to run to lock in 2% for 30 years when inflation is at 7.8, 7.5.
Yeah.
And probably going to be worse over the year. It doesn't make sense to me.
No.
It's kind of like you must think the threat of recession is more likely than the threat of inflation.
Exactly right.
And do we think that?
Does anybody think that, really? Well, if you think that, you probably used to be in the transitory camp, and you kind of
probably.
You probably just adjusted your argument so you don't feel too bad about the whole thing.
Yeah. Not to say we don't think recession is a future likelihood.
Yeah, no, we definitely think that it's to solve this whole problem. Historically, it's been a recession that has been the result because because the Fed has let inflation get so far away from them, and it will continue to. We think interest rates will have to kind of be pushed well above or where they're saying at the moment to combat inflation. Exactly.
And when you have to move so drastically like that brings on recessions. So, sure, in the future, absolutely, that's in my mind. How the bond market is going to be impacted from March when you've got the Fed pulling out.
And there's still going to be a purchaser in the market because the bonds that they currently own that roll off, so they finish their duration basically, and they get their capital back. they still are saying they plan to reinvest that back into the market. So they're still going to be a part of the market, but they're not going to be a net acquirer.
No.
That's the difference, is they're not going to be an active buyer of huge amounts in the market.
Sure. The MBS roll-off, whatever amount that is,
Yep.
or whatever bonds expiring, put that back into long-term if you want.
Sure.
In the same breath, though, the Fed still has a lot of long-term bonds on their balance sheet,
Big
which
time.
they can sell back into the market to affect the yield in whatever way they want.
Exactly.
And so that's when you've got to think, well, how are they going to want to affect the long end of the yield curve? Do they want people paying more interest for their home loan or less interest?
Exactly.
Right
and
now.
imagine right now if they raise interest rates to 2.5%, 3%, but you could still borrow at 3.5% for a home or for something and everything's going up like crazy. It's not fighting the battle on the two fronts. It's only fighting the battle on one front. It's you're allowing people to consume still by borrowing at long rates, and it doesn't make sense. And there's absolutely no chance, from what I can tell and from everything I understand, and from listening to Joseph Wang and all these people who are insiders, there's absolutely no chance that they will just allow long-term rates to stay low while they're trying to fight inflation. So pretty confident, I think. It's gone in our direction already, which is good, because the long-term, I think when we put our hedge on, the 30-year rate was 1.8%, and now it's 2.3%. So it's actually, gone 50 basis points already, but we think it's only the start, and we think probably there's another 100 basis points at least to go. The time period, we don't know, but, the resounding, overwhelming calls to fix inflation, it's 70% of people say it's the number one thing they're worried about. They're kind of damn they do, damn if they don't. Before Volcker came in the 70s and started to fight inflation, they were hating on the government for creating the inflation. And then when Volcker had to try and, solve it,
inflation.
People were throwing bricks through his windows, and they said there was I heard somewhere there was farmers who were blockading the Federal Reserve and they couldn't get to work. It's not popular either way.
It gets pretty messy pretty quickly.
And that's why in the 70s you had all these periods, from our research, you had all these periods where they would raise interest rates, inflation would kind of subside, and then people would get upset about that. So they would get upset about the downturn, which kind of cools the inflation. And then they would say, okay, fine, we're just going to stimulate again, and off the bubble goes again. And then people are annoyed about inflation, and people kind of they build the resolve to try and do something about it, but they don't do it properly. And that's what Volcker did. He raised interest rates when inflation was 15%. He raised interest rates to 20%, and he kept them there until it was coming down, and he kept them higher than inflation. So if you can imagine what that would do if inflation stays high, if you can imagine what that would do to all the companies that have debt right now, if they, instead of paying 3%, had to be paying 7 or 8%. It seems far-fetched. It seems insane to think that. It seems crazy, but inflation is the problem, and you just can't let it continue.
Yeah.
You have to do something about it. So.
And a lot of people say the Fed's restricted really by how much they can raise rates because of their own balance sheet.
Right, yeah.
But I think we're looking at it from the point of view of they need to look after their citizens more. Where is their priority? Is
their priority in maintaining the value of their bond portfolio? No, it's not. That is a tool. That's what people say. They say that, they're going to lose a whole bunch of money if they raise interest rates. They don't care. That's just digital money. It's just a little number on a spreadsheet of, create digital money. It's not important. What's important is the real economy, and their job is price stability.
But you're talking about 300 million people in a country where 100 million people who are the worst off are going to be screaming because they can't afford fuel and food anymore. What is more important to tackle?
Exactly. And that's where inflation is so bad, because there's a massive inequality to people who own assets are watching those assets appreciate, and that's makes them feel good, makes them feel wealthy. They're happy. Oh, this is going great. People who don't have assets are watching their food bills, their fuel bills, housing costs, rent costs. It's terrible. It's not fair. It's all ultimately from the amount of money that's been created.
And it's sitting in the top, and it needs to funnel down to the bottom.
Exactly.
But their wages aren't being increased to the rate to cover their increased costs, and the wage increases are making the problem worse. So it's,
I know. It's definitely a feedback loop that someone needs to do something about, and hopefully the Fed does their job, and they,
yeah, Fed do job.
Cool. So discuss the hedge. The hedge. So it's appreciated. Great. Whatever. It's still got a long way to go. There's a couple of different ETFs. There's one called Govs, which you could buy puts on. There's one called TLT, which we own puts on. They're all long dated bond ETFs that would all, when you run the numbers, they all should fall 30 to 40% in that range somewhere.
We think so.
If rates go up, anything can happen. Do your own research.
If
you don't understand what puts are, watch some YouTube videos about puts. Get into it. Understand it, and then just size it so that again, not investment advice, but if you're interested in it and if you want to, just size it as small or as large as you want. Like our position is now 11% of our portfolio, because we feel like it's very, 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 very likely that they will have to push those long rates higher to to make buying a house more expensive, and in turn 18 months later reduce the amount of inflation that gets shot into the CPI from the housing number. Simple as that.
Yeah, and obviously we're always totally open to losing that entire 11%. That is the risk you take.
Yep.
With situations like this, when things can change, you've got potential war on the horizon with Russia and Ukraine. So how that affects the bond market.
Well, historically, the bond market is a flight to safety. So when a bad thing happens, people go, "Oh, quick, money into bonds." So that's where you could have bond rates fall. So money flowing into the bond market, long-term bond market, under a perception of safety, or if there's a world war situation. But I don't put that at a high probability. Putin's not stupid. Like, I don't think that it's a huge thing to worry about from what I can tell.
No. I can't see many buyers around really for these bonds at these rates.
And why not go into gold as a flight safety? If you're talking about flight safety, why not go into something that's been historically a great store of value over inflationary periods and periods of turmoil? Like, there's better options that people could go into. But yeah, that's the risk that you could have. Yes, inflation's really bad, but then war breaks out and there's a huge flight to safety, and that could push the rates down. So it's not a position without risk by any means.
No position is
at the moment. And I think that if you think that because you've got a large position in a company that you understand, trading at 15 times earnings, 10 times earnings, twice book value, like, it doesn't matter. Like, if rates go up 3%, 4%, all that stuff's going to get a haircut.
Yeah, just make sure whatever you're holding can take a haircut.
Exactly.
Add a little bit of a margin too.
Add a bit of a margin. Exactly right. So there's still opportunities out there. But yeah, it's continued to sort of progress along as we thought that it would.
Yeah.
I don't think we've been right about everything, but we're right in the sense that it's going to get worse. It has been getting worse. And then the Fed is, facing reality at this point, or starting to really face reality.
Yeah. I guess it's just like when we see things like this happen, like when before the COVID hedge, we just kind of wished we'd been louder, because we heard all this rubbish being spoken, people who are meant to be experts, but they're obviously incentivized to say something for their own benefit. And that's happening again. Yeah. And so luckily we have a podcast now. So luckily we can say, with
dozens of listeners.
Yeah.
Yeah.
We can say, we can talk about this stuff and help other people benefit from it, because that's what changes lives. And all of the people that we talk with through our Twitter feeds, they're all like good people who are trying to grow their capital and make a good impact on the world. And those people should have more of the money.
Yeah. And who do you think the money's coming from is? If you short a bond ETF, that's a massive hedge fund that's probably writing those contracts. That's probably, that's where the money's coming from. Like, the money's not coming from, you're not fleecing someone on the street who needs the money. Like, no, it's the money's coming from. So if you talk about, anti-Wall Street, anti-establishment stuff, then this is actually probably the way to do it. Again, we won't benefit from anybody because there's so many different options and so many different like durations and so many different ETFs you could do. Like, as absolutely zero chance that anyone would have any impact on the pricing of our specific option. Like, that's all tied to the underlying ETF. The underlying ETF is what sets the price of that option. So unless someone's listening who's got like $4 or $5 billion and they push all that money, into TLT, this is not, we wouldn't benefit at all from any of that. It's just all about understanding the problem and working out if you want to try and benefit off it, basically.
Yeah, and you don't have to take out a hedge. You don't have to take out options. Even if this just makes you think, if inflation wasn't on your radar and now it is, and you hold like a lot of US equities, if that forces you to think, well, maybe I'll pull out of the US and try a few different emerging markets, or like I'll try commodities or something a little bit more defensive.
Raise your cash balance from 5% to 15%. Like, and any of those things will give you buying power if there is a decline, and that may be buying a bond ETF at a high yield. I don't know, like it might be a whole different option that
we might be doing that in a year.
It might be a buyer, who knows. So yeah, I guess cannabis is going well.
Imagine the synergy of that if that plays out this year.
That would be good. It looks like the safe banking, so the banking part of that legislation looks like it has a good chance of getting passed, with a lot of politicians talking about larger legislation, on the cannabis front. But that could be good or bad for the companies that we've looked at and the company that we own, depending on what legislation is. So there's still heaps of risk there. But again, they'd be crazy not to try and get something done on that. It's bipartisan. Before the midterms, it's a very popular policy. So fingers crossed, logic prevails there, and they try and distract the people from how bad inflation is by making weed more available.
Yeah, but basically, like, the only exposure we have to the US now is our cannabis investment and our land bank Howard Hughes investment. So we see that as both very inflationary, defensive.
Yes, definitely.
I mean, air's going to be up against it probably with increased fertilizer costs.
That's true. But
you're talking about these businesses with pricing power.
I mean,
depending on who they are.
And the good thing about air is they are focusing more on branded products as opposed to just selling the flower itself. Like, by focusing on drinks and edibles and things like that can be branded and packaged well, history would tell you that those things generally will have a higher margin than a raw product. So that's what they're going towards. Like, for example, I noticed that in Florida, so Liberty Health, which is owned by Air Wellness, second highest seller of THC, but sixth highest seller of flower. So I saw that, I was like, oh, well, they're obviously just selling loads of products that aren't flower, aren't cannabis flower, which I think is a smart business direction to go in. But yeah, still trading at crazy low multiples, and still, who knows?
They're already paying above 10% interest rate, so that's not gonna. They might actually have a lower interest rate this year than other companies.
Exactly. Everyone might be like, interest rates for your average company might go from 3 to 6, and Airs might go from 10 to 8, and everyone's like, oh, this is fantastic,
amazing.
Oh gosh.
So that's looking positive.
A
little bit of shining light in our day.
A little bit.
Amidst all the stomach turning
volatility.
Yeah,
it's pretty crazy. But as always, thanks for listening, and any questions, send them through. And good luck.
Good luck. If we've got a note for the Fed, it's like, if you want to amputate a leg, don't start with a toe.
Exactly.
That's all we'd say.
It's like, cut out the problem.
Just cut the leg off. Get to it.
Just do it. If you got this far, thank you so much for listening. We really hope you enjoyed the conversation.
Now, if you'd like to become my 22nd
or my 43rd
follower on Twitter, links are in the show notes below. Mitch, anything else?
Nothing to add.